We're in the LA market, so in that market, we're dealing with people that have property, and a lot of times we're dealing with people that are older and have had property for a long time, and the property values have gone up pretty dramatically, right? And it's a fantastic time to sell property, because guys are getting property values that they never expected to get. You could have bought just about any property in Los Angeles area, say 7, 8 years ago, and it's pretty much doubled, and there's actually some areas that have tripled. So it's gone up pretty dramatically. And so it's a fantastic time to sell, right? But then when you talk about buying, that's a whole different subject. So, because you're selling at the top of the market, but then you're buying into the top of the market. And so in this kind of market, you have to be much, much more careful about what you're buying and how you buy it, etc. And so I'm here to go over strategies that we're dealing with our clients and how to handle all these issues. So again, we're kind of a full-service real estate brokerage. Eddie here and Michael, who's running around somewhere, there he is, are brokers with me. And so we have a very large database of investors, and so we deal with listing properties for clients. Now we're dealing mostly with investment properties, right? Income properties, so multifamily, commercial, stuff like that. And then we do single-family homes as well, but again, stuff that's really geared towards cash flow. Here we are, going here. So probably about 15 years ago, I was dealing with a client, and they were older, and they had a property that was a rental, but they just couldn't look after anymore. And they're like, Rusty, we're selling this property, we just have to get it out of our hair. Our kids have moved out of state, we're told to look after it anymore. When they learned about how much taxes they were going to pay, that's when they learned all about 1031 exchanges. And so I ended up handling that transaction. I put them into some property where they didn't have the management headaches, and they were very happy about that. Since then, the whole subject and area of 1031 exchanges has become kind of my area. Probably 70% of the transactions we're involved in through my office are 1031 exchanges. So we do other stuff as well, but that's just the big thing. And again, we're focused on income property. The vast majority of the properties that we're dealing with are off-market. People don't realize that, but when you get outside of the residential market and you get more into commercial stuff and that, close to half of all the transactions in America are actually off-market, which a lot of people don't realize that. We're doing commercial, we're also doing single-family, and we also do investing for clients through IRAs. So a lot of people don't realize that through an IRA, you can't actually buy real estate, but you have to be dealing with an IRA company that allows that. So we help people do that as well. So a lot of my clients, like I said, tend to be older. They've had property for a long, long time. They've taken most of the tax advantages of it, and they also have retirement accounts. Now here I'm going to talk a little more about the big picture, not just real estate, but when we look at the whole world of finance, as you know, interest rates are very low, right? And it's really changed the whole financial market in America, if not the world, okay? And so if you're a person that's counting on having some kind of investment that's going to pay you income, CD, bond, or whatever it is, it's really tough right now. It's very, very hard to find some form of investment that gives you any kind of half-decent cash flow. And it's a big, big problem. 10,000 people a day are retiring right now in America, right? And not just that, we've got big pension funds, etc., and they're all struggling to put their money somewhere that makes sense, okay? So you guys know this already. If I would have stood up here, let's just say 12 or 15 years ago and said, folks, you're going to have problems trying to find a CD paying more than 1% interest, what would you guys have said to me? Crazy, exactly. We never could have imagined this, right? I mean, interest rates going this low and staying this low for this long, it's never happened in our lifetimes, and I really don't think it's happened ever in America like this. So it's a very, very unusual situation, but what it's done is it's really altered the financial markets dramatically. Okay, so I like talking about 10-year Treasury rates. The reason I like talking about it is the whole world wants to own U.S. Treasury bonds, okay? Because they're considered one of the safest investments in the world. So you hear about the Japanese and the Chinese and everybody else wants to own our bonds. But also large pension funds. You take, the state teachers retirement system, CalPERS, all these kind of big, large pension funds, they want to have a huge percentage of their money invested in something that's low risk and gives them a half-decent return. Traditionally, 10-year treasury bonds would pay somewhere around 5, 6, 7%. Today, and this is just updated a couple days ago, we're at about 1.5%. Okay? And that's a problem, because these large pension funds and stuff, we're planning on getting a little more than 1.5%. And so and it's not just these large pension funds, it's institutional money, it's just retirees. You know, I see it all over where people are like, oh my God, I used to get 5% on a CD and now I, 1 or 2% or something like that. So it's really changed what's happening in the financial world. So now the big question is, what's the future for interest rates? Now, we know that rates were pretty much stagnant for a long time, the last 4 or 5 years when Janet Yellen was in, and then when Jeremy Powell got in, he started raising rates. He raised them like 5 times last year, but then things kind of sputtered. Rates have actually started dropping again. Now, I can boast here a little bit because I predicted rates were going to go down. It didn't make sense at all to me that they were going to go up except for maybe a little smidgen, temporarily, and this is one of the reasons why. So we took, and again, you probably won't see this anywhere else. This is just the way I've looked at this in my office. You take a look at 10-year bonds from all the major industrialized countries and just see what's happening, okay? So if you were to buy a 10-year bond from China, paying about 3%. You buy a 10-year bond from Greece, 1.75%. USA, we talked about it, 1.5%. Canada, where I'm from, a little over 1.1%. Hong Kong, a little over 1%. Italy, same. Taiwan, 0.7%. See a pattern? United Kingdom, 0.44. What's that?
Do you have anything to say about what's happening globally with negative interest rates?
Well, that's the next thing.
Okay, there we go. Okay.
France has gone negative. Germany went negative.
Okay.
Pay for them to keep your money.
Right.
And I don't want to get into the whole subject of negative interest rates because I've yet to get my arms around it. But it's basically, you're right. If you were to buy a bond from Switzerland, you have to pay Switzerland to have that bond. You're paying them 1%. Now, Switzerland makes sense because their currency is based on the gold standard, right? And so if you were buying bonds from Switzerland, even though you're losing 1%, the value of those bonds went up quite a bit because of the exchange rate. Okay? Anyway, I don't want to get into the negative thing, but the main point here is that we're sitting here thinking that our interest rates are ridiculously low, right? You're going, this is crazy, You're getting 3.75% mortgages right now, okay? But guess what? We're at the high end of the scale. The rest of the industrialized world is lower than us by a big long shot, okay? So what does this do? Well, if you're sitting over in France, for example, and you got a whole bunch of money to invest in your pension fund or whatever, you're going, okay, well, do I buy French bonds or do I buy U.S. bonds that are paying a whopping 1.5%? Where are you going to buy? You're going to buy U.S. bonds, right? And that's what's happening. Money from all over the world is coming to America. And it's been happening for a while. Now, when everybody wants to invest in something, what happens to it?
Goes down.
No, the opposite. Exactly. Everybody wants to buy U.S. assets and U.S. money, right? So it's pushing the U.S. dollar up. So I'm sure you guys have done some traveling. I've done, we go on trips all the time. And you're going to find that when you go to Europe, the euro's down a lot compared to what it was, say, 7 or 8 years ago, right? Same with the peso, Mexico. I'm from Canada, so I go up there quite a bit because of my folks and stuff. Probably 5 or 6 years ago, the Canadian dollar was pretty much on par with the U.S., within a couple percent. Today, it's down almost 30%. But the truth is, it wasn't that the Canadian dollar went down. It's the U.S. dollar that went up. Because all the other currencies, if you check them out, they've all gone down. So it's really the U.S. dollar going up. And again, it's because of money coming in from all over the world, pushing it up. So there's 2 reasons. Our interest rates are higher, and what's happened to our economy. We're kicking butt. We're probably the best economy in the world right now. And we have been for quite a while. And so, and you guys are, you guys in the Santa Barbara market, down here in L.A., we're all familiar with Chinese. And so there's a ton of, Chinese are buying assets all over the place. You'd probably be surprised to hear this, but in the last 10 years, there was only 1 year that the Chinese bought more real estate in America than Canadians. Canadians traditionally buy way more real estate in America than the Chinese. Now, we're talking about the whole United States, not just, LA. So it's not just the Chinese bringing money in here. You can talk to, if you look at it, money comes here from Germany, Central America, all over the place. So again, our interest rates are low, but they're much higher than everybody else's. So it's kind of skewing things. And then the next question is, well, what's going to happen with interest rates? Truthfully, when you look at this, this is the other thing I should tell you about. So with the US dollar being really high, we're working really hard to make America great again, right? So what does that do to our exports? Makes them really expensive, doesn't it? We're one of the biggest manufacturers, well, we are the biggest manufacturer of airplanes, right? So if we're selling an airplane to, who knows, somewhere in Central America, let's say Colombia, it makes that airplane really expensive because our dollar's gone up so much. So that's not good for our exports. So we can't keep we can't have our interest rates be that much higher than everybody else's, right? Because last year everybody was going, we're going to raise rates, we're going to raise. We're watching what's happening in the rest of the world, and they're not raising the rates. They're actually lowering the rates. So we can't have this huge differential, making it any more than what it is, because it's really going to impact our economy in a bad way, because it's going to really limit our exports. So again, if you're going to make an educated bet here, I have a bet saying that interest rates are going to have more pressure on them going down than they are going up. And then when you look at these numbers here, Europe's rates went down quite a bit just in the last 3 or 4 months. They went down to the lowest we've ever seen them. Lower than what they were back, believe it or not, in 2009-10. So that's a little scary. But the main point here is that I just don't see rates going up. I think they're going to probably go down some more. And as if you're watching what's happening with real estate, the end of last year, in LA anyway, things started slowing down, and then interest rates started dropping again in the spring, and suddenly there's a new surge of buyers. And so we're seeing the activity in LA as strong as it ever was right now, even though prices have gone up so much. So anyway, it's kind of interesting to see what happens. So, and then so one other thing I should talk about, well, I'll come to that in a minute, but one good thing about America as well is that we have one of the best growth rates, population growth rates in the world, believe it or not. For any major country, we grow much better than everybody else. So what does that mean? Well, that means that it's great for our economy, right? There's more people wanting to buy houses, more people wanting to live in apartment buildings, all that kind of stuff. We actually add about 3 million people a year to our population, which is a combination of immigration and the birth rate. Now, you compare that to other countries, especially Europe right now. A lot of countries in Europe are breaking even or shrinking. In fact, Germany last year recorded the lowest birth rate of any country ever in history. They're having like 1.1 babies for every 2 people. So, how good is that for the economy? Not good. You Google Japan. Japan's been shrinking by about 300,000 or 400,000 people a year for a while now. In fact, I saw an article earlier this year that you can actually get a house in Japan for free. They're giving them away. They just want people to pay the property taxes and maintain the home. Now, I'm not sure what areas it was, but there's so many empty houses right now in Japan. And that same thing happened in Detroit, by the way, when we had the crash. So who wants to buy an apartment building in Japan? It doesn't make a lot of sense, does it? Exactly. You lose your tenant, it's kind of hard to find a new one. So anyway, that's bad news for those guys, but here in America we have very strong growth. Lending is still kind of restrictive. You're seeing a lot of new construction, but guess what? When we had the crash back in 2008, what happened to construction? It stopped, dead. Developers either went out of business or couldn't get a loan. So we had about a 5-year period with practically no new housing or construction here in America. Did we stop having babies? No. We still kept growing at that three-person rate every year. And so there's a huge pent-up demand right now in America. So even though you're seeing a lot of new apartments and a lot of new stuff going up, it's filling up really quick. And then if you guys have rentals, I know in the LA area, if you get a vacancy, you can fill it real fast. And you can usually raise your rents right now too, because there's a shortage of housing, big problem. Okay, so this is all good for real estate. So where are the opportunities? Again, with interest rates being really low, there's a lot of money out there looking for a home that gets more than 2 or 3%. And rental properties is still one of your best bets when you look at the big picture. And just to talk about cap rates, you guys familiar with that term?
Yeah.
So the cap rate is really a calculation of the income you're getting from your rent, minus the expenses, versus the fair market value of the property. I'm familiar with the San Gabriel Valley, which is the Pasadena area. Back in the 90s, you could buy an apartment building all day long that was paying 8 or 9% cap rate. You could buy $1 million building, and you could easily expect, and again, it was normal back then, to get 8 or 9%, which is $80,000 or $90,000 net income after your expenses. Anybody know what the median cap rate is now for apartments in a LA area? Between 2 and 3%.
3.1 like you got here.
Exactly. Exactly, and that's normal today. And so you have to ask yourself, if you've been in the real estate market for a long time, why would somebody buy a building that's only paying 3%? Right? Because you just need one little hiccup, right? You need a leaky roof, you need a couple of tenants to evict, and air conditioning blowout, and there goes your profit for the year. But again, when you compare it to other investments in today's world, it kind of makes sense, right? And I see with clients that come in, I had this bond, it matured, I might as well go buy a property because I can only get another bond to replace it that pays 1 or 2%. So if I can get 3% on a rental property and see all these great, tax benefits in that, I might as well buy an apartment building or buy a duplex or whatever it is. And the same thing is happening on every level. Large institutional money, pension funds, everything else are allocating more money towards rental property because they're seeing better cash flows and better returns on the rental than they are in bonds and other kinds of investments. So it's pushing a huge amount of money into real estate all over across the board. Again, lending, it's still kind of tight for the most part. Cash is king. In LA, 45% of all real estate transactions are all cash. So does that tell you that it's because of mortgage rates that we're seeing all this buying? No, because half the people buying aren't even getting a mortgage. And we're not talking about houses, we're talking about everything. Apartment buildings, shopping centers, skyscrapers, the whole bit across the board, almost half are all cash. And I've seen some other similar stats in other cities as well. So it's kind of an interesting market. Again, cash is king, so you go to buy a property, and we see it all the time with clients. You get 3 or 4 other people coming in with all cash. And you're trying to fight that if you're trying to get a loan. So it makes it tough as a buyer, and it's pushing prices up. Okay, so another thing I heard earlier this year was kind of interesting. I was listening to the thing on the radio, and they're talking about how Los Angeles is now officially the most expensive city in America to live in based on its median income, right? What the average person makes, right? So, for example, we all know that rents are far higher in the Bay Area or New York, right? But guess what? People up there make way more money on the average than they do in LA. So again, this is a chart here showing affordability, and Los Angeles for rent is the highest in the country based on the average income of people living there. Okay? So if you're going to buy a building and you buy it at a 3% cap rate, and you want to sell that building later and make a profit, what do you have to do?
Raise the rents.
Somehow you have to raise the rents. But we're already in the highest rent market in the country. How much higher can you raise those rents? It's tough. So you got to be careful in this market. I mean, if you find a property where it's under market rents and things like that, well, that's a little different. Yes?
This may be a little off topic, but isn't that a big indicator of the market flipping around once renting is no longer affordable, and then the cost of owning also isn't affordable?
You get the gold star.
I just wanted to.
Exactly. You're right. And then just a couple other charts to go along with this. Mortgage affordability, again, LA is the highest in the country based on the average income. And then also price to income ratios for homes. Same thing. So you're right. You have to ask yourself, how much higher can rents go and how much higher can prices go based on those rents? And that's a big question. And then another huge headwind, which we're all familiar with, we know that we tried to pass, we didn't, some other people tried to pass Prop 10 in November's election last year, right? And if Prop 10 had gone through, which it didn't, it would have repealed the Costa-Hawkins Act. And the Costa-Hawkins Act actually limited rent control, okay? So if the Costa-Hawkins Act was eliminated, there would be no limits on rent control. Every city in California could have their own rent control rules, okay? Would that be a good thing for us landlords? No. I meant no matter where you bought a property, you know, and I know Pasadena's pushing hard for rent control, Glendale, where I live, is pushing hard, Long Beach has been trying to pass bills. In fact, it's so bad, somebody sent me this a couple weeks ago. These are all the bills right now in front of the state of California having to do with some form of real estate and rent control. So the pressure's not relenting in that, yes?
If rent control has never been proven to be good, would you say it's just the legislatures wanting to get elected?
Totally. In fact, you know, and again, we can have a whole seminar just on this, but they've shown, it's sort of like gun control. Wherever you put more controls in an area, you know, the thing they're trying to eliminate gets worse. I mean, you know, in LA, you know, if you're scared to have a tenant because you're going to be stuck with rent control and all these other things that happen, are you going to build more, you know, apartment buildings and stuff, you know, or rent your home? I mean, believe it or not, we just got a client who's an attorney up in the Bay Area, and he's on a lobby group heavily pushing against rent control. He told me, and I was still flabbergasted by this, he told me that right now today in the Bay Area, there's 30,000 empty units because of people just refuse to rent them out. He said, he was telling me story after story of clients he's got that went to rent a property, and when they found out all the rules that are passed now and all the problems of being a landlord, they just said, forget it, I'll just leave it empty. And so again, that's a perfect example of what you're talking about. So the more you try to regulate something, the more problems, because you're never going to have a regulation that's going to, you know, I can't say there should never be any regulation, but anyway, it just gets kind of crazy. So again, this is just another headwind as being a property owner in California. Okay, so here's something, totally change the subject. This is obviously a map of the United States, and it's comparing the economies of each state to other countries. So this is kind of cool. California, if it was its own country, would be the 5th largest economy in the entire world. And its economy is actually larger than the United Kingdom, just California, right? Second largest is Texas. Texas has a larger economy than my homeland, Canada. This was interesting. The economy of Florida is larger than the entire economy of Mexico. Wow. Yeah. And even stranger, Pennsylvania has a larger economy than Saudi Arabia.
Wow. Net worth and everything.
Yeah. Well, I don't know about net worth, but just the size of the economy, the GDP, gross domestic product. If you took all the different states and just made them countries, and you took the top 15 countries in the world, 5 of them would be states in the United States. I mean, just to give you a grasp of just how massive the economy here is in America. It's just light years ahead of everybody else. And so, you know, even though we talk about China, China's economy is 2/3 of ours, but they've got how many people?
Over a billion.
They got like 1.2 billion or some numbers. So they have like 4 times as many people and a smaller economy. So anyway, just the thing is that when you look at the whole picture of what's happening in the United States, you know, get outside of California, there's just a lot of things going on, and it's just a very healthy economy overall. All right, so I'm going to switch subjects again, and now we're going to talk about taxes. As we all know, we had our tax laws changed a year and a half ago, and we can debate good and bad stuff about it. If you're a business owner, it's a good thing. But what I'm going to talk about specifically is 1031 exchanges. And so when they were debating the new tax laws, there was talk about eliminating or changing the 1031 exchange rules. So the good news is that 1031 exchanges for real estate stayed the same. The bad news is that there were other types of 1031 exchanges that were occurring, but they all got eliminated. And you probably didn't even know about this, but if you had artwork, for example, you had a piece of art and it went up in value and you sold it, you were allowed to do a 1031 exchange on that piece of art, you know, painting or sculpture, whatever it is. Fleets of trucks, heavy equipment, airplanes, there's all kinds of stuff that were done on a 1031 exchange basis. And then 1031 means you don't pay any tax on the exchange. All that's eliminated. The only thing that's left is just investment real estate. So for us guys, that's a good thing. So I'm gonna walk you through the rules for 1031. When you're selling a property, that's called your downleg, okay? When you close escrow on that sale, you have to transfer the money to an accommodator, and they're gonna hold the money for you. And I belabor this point because you have to have this set up before you close escrow. I've actually had it happen, true story, where someone's called up and said, hey, I closed that escrow and I got my money, how do I do that 1030 exchange? It's too late. Once you get that check issued to you, it's over. You have to pay the tax, okay? So again, have this set up ahead of time. Money goes to an accommodator. Then you pick your new property you're going to buy. That's called your upleg. And your money has to go directly from the accommodator to the new escrow. If you ever done an IRA rollover or 401k rollover, it's really the same concept. You can't take the money. It has to go from one institution to another. Same thing, right? Okay, so that's that. When your property closes escrow, that's day one.
Just a quick question, Rusty. I saw on the slide it said 30 million to 30 million? Or three, oh, okay, 3
Oh,
million
3 million, yeah.
to 3 million. So you don't have to purchase for more than what you sold for?
Correct. It has to be
Okay.
equal or greater.
Oh, okay.
Most times it ends up being a little more, but,
Okay.
yeah, or it could be less. If it's less, you pay the tax on the difference.
Oh.
Like we've actually had clients say, look, you know, I just want to cash out $100,000 and pay the tax on it because I'm asset rich and cash poor. You know, you have to take a look at every situation.
Okay.
But to get around all the taxes equal or greater. Yes, ma'am.
So, if you had a rental property that was worth $3 million and you wanted to transfer it into two, like, you had a triplex and you wanted to get two fourplexes that equaled $3 million, but each one was 1.5.
Yeah.
Is that possible?
In fact,
I'm ahead.
yeah, exactly. You'll see my next slide as we go along. All right, so here we go. Day one is when you close escrow. The clock starts ticking. You've got 45 days to pick the property you're going to purchase. Okay? And on the 45th day, there's a form you have to fill out with the accommodator, and you're going to identify the properties you want to buy, whatever it is, 1 or 20 or whatever. Okay? But by midnight, the 45th day, you have to have that filed with the accommodator. We've actually done it 15 minutes to midnight, the 45th day for a client one time. So that's the deal. Once that 45 days goes by, you have an additional 135 days to actually close the escrow. So the total is 180 days. Right? Everybody gonna pass the test after this? Oh, good. But this is really important because, again, that 45 days is gonna be crazy. And especially in a market like we're in right now, trying to find replacement property can be just, honest to God truth. We had a lady come into our office last November, and this poor woman, she was this little Chinese woman, and she had sold her property, and she came to us on about her 42nd day, I think she had. So she only had a few days left. She's sitting there going, she actually had gone out and looked at over 200 properties and bid on, she didn't bid on all of them, but she'd actually gone out and looked at them and put offers on a bunch of them. She kept getting outbid. She just didn't find what she wanted, right? So in a market like today, that 45 days is really aggravating. So anyone we're working with, we're saying, look, when you go into escrow to sell your property, you got to have a plan, right? And kind of what we're going to get into today is we have an inventory of properties that you can exchange into, that are mostly off market, so we don't have that mad scramble, but, it's up to you. But I'm just saying, you want to be prepared ahead of time, because this is really, really, you're going to get more gray hairs. All right, so then the next thing is what we call like-kind exchange, and so there's a lot of questions about this. Obviously, you sell an apartment building, you can buy another apartment building, but the truth is you can buy any type of investment property, okay? So we did a parking structure actually in Cincinnati with some clients a couple years ago. Single-family homes, as long as you don't live in it, it has to be an income property, a rental property. Oil and gas leases, we've actually done some of those. Medical office, raw land, triple net lease properties, storage units, virtually anything that's considered an investment property and it's within the United States, you can do a 1031 exchange. Okay? So it's pretty wide open. And you can do combinations of this as well. Okay, so, we talked about multiple, and I don't want to get into the rules too much today on how many properties you can do, but most people are familiar with the 3-property rule, which means you can do 3 properties. The truth is you can do as many properties as you want, as long as they fit what's called the 200% rule. And that means if you sold a property for $1 million, you can identify up to $2 million worth of properties, and it has nothing to do with how many properties it is. So we've actually done exchanges with 20, sometimes 30 properties. You can't do that as long as you're in that rule. Okay, but by splitting your money up between more than one property, you can actually go into different markets around the United States and diversify your equity.